Welcome to Chapter 15, Monetary Policy and Banking Regulations. We're going to talk a little bit about how the Federal Reserve Bank works here in the US and central banks in general work in countries around the world. We'll look at how they might implement monetary policy and what the effects of that might be and what some of the challenges or pitfalls related to monetary policy countries can run into. So today, if you were to look and see who the chair of the Federal Reserve is, it would be Jerome Powell. You may often hear him referred to as Jay Powell, this gentleman down here. But just before him, Janet Yellen, one of the first woman to hold the position as chair, and that's a picture of her. The Federal Reserve has actually 12 regions, Federal Reserve banks, each of which has a head. You can see the way that those 12 regions are broken out here. You'll note that one of them is, number 2 is New York State, because of the history of how the country developed and population and influence between markets and national governments. You have some smaller districts in the Northeast. So the Federal Reserve System has a board of governors. 7 members make up that board of governors that are appointed by the president, as well as the chair is an appointed position by the president. You've seen that they're geographically diverse, and the 7 board members have a non-fireable 14-year term. So the chair is elected for a 4-year term, but the Board of Governors, these 7 members, non-fireable 14-year term. We talked about the 12 districts and each one having a bank, and they're responsible for the banking system in their region, and then they make decisions collaboratively that impact the nation. And then they have an open market committee that includes all of the 12 members, the 7 governors, plus 5 district bank presidents, and one is always from the New York district bank. The other 4 rotate. So New York's bank, because we're the financial capital of the country, it always serves on that board. So bank runs are not something that we've experienced. I've not seen one in my adult life, but you may have seen depictions of them in movies like It's a Wonderful Life or Mary Poppins. And it has to do with the fact that we talked about banks when we looked at how they are able to take in loans or take in deposits and make loans because they have a reserve rate. They keep a percentage of the deposits on hand, and then using the money multiplier, they begin to loan that money out to help our economy to grow and function. And when they do that, it meant that if everyone came to get their money out of the bank at the exact same time, the bank actually doesn't have our money in its possession. Some of it's lent out to businesses, some of it's lent out to government, some of it's lent out to you and I or our families for things like cars and homes and college loans. So the regulations that are put in place by any national government are to try and ensure that banks remain solvent even during more concerned times where individuals and companies may be less likely to keep their funds at the bank without wanting to have direct access to them. So reserve requirements are one of the ways that we do that. There's some capital requirements and restrictions on the kinds of investment and the level of risk that banks are allowed to take. And they're insured by the federal government. So you might see a FDIC insurance sticker on a bank when you walk into it, or you would note it on the website if you were doing online banking. But almost all banks, and you should only be working with a bank that's FDIC insured, it says that if the bank fails, the owner will still get their money. The government's backing it up to 100,000 originally. Today, it's really 250,000 per account, or 500,000 for a joint account, which covers the vast majority of individuals, at least. Corporations often have much more money than that. And then the Fed is what's known as, that's the Federal Reserve short. The Fed is the lender of last resort. When banks can't raise the money and funds that they need from other sources, then the Fed will loan them money. In fact, during this pandemic season of 2020, the Fed had stepped in, and that was part of the stimulus package, the CARES Act that happened, that they guaranteed that they would provide the funds that were needed for banks if no one else would. They did the same for companies that helped the banks to be lending and continue to take risk that might have felt too much for them otherwise. So it was a really important role for them to have played during that time. So when the bank looks at monetary policy, it's either trying to expand the economy or contract the economy. And if you want to expand, you do one set of things. You do the opposites if you want to do contractionary policy. And one of the ways to do that is to either for the Federal Reserve to buy or sell government treasury bills. Those are just really loans to the government in the secondary market. So in expansionary policy, they're buying US Treasury bills and putting money out into the hands of businesses and individual consumers to spur the economy. They'll pay with reserves, increasing the bank's ability to loan. So they help the banking system have more opportunity to lend to borrowers, which increases the money supply. And when you have more money, each of those dollars has, because you've increased that scarce resource, the supply of money, you actually make it easier for people to get their hands on money. So the interest rate that you can charge for money has gone down because there's more of it around. And you can think of that as kind of a price of the good of money. And that increases new investment and expansion in the economy. Businesses invest in future growth, and consumers buy new products for their home. New homes are being built. They buy their first homes. They move from smaller homes to larger homes, those kinds of things. In contractionary policy, then, the Fed actually sells those treasury bills and from banks, and the banks pay with reserves to the Federal Reserve, decreasing their ability to loan the money they have on hand, which decreases the money supply. As a result, every dollar that's out there becomes more valuable, and so they can charge higher interest rates. So we see an increase in interest rates, and it decreases the investment in the future and in upscaling our lifestyles as consumers, and it causes the economy to contract, which if it's overheating, if we're worried about things growing so fast that it's creating bubbles, or that we have taken on too much risk, this is a reason to consider contractionary policy. So the reserve rate, which I've talked about a couple of times in an earlier chapter, in the last chapter, and in this one, is the percent that the bank has to keep and hold at the Federal Reserve in their vaults. And remember, the money multiplier is 1 divided by whatever that rate is. We used an example of 10% or 0.1. So it would multiply money 1 divided by 0.1 10 times. The higher the reserve rate, and it does change, the Federal Reserve does raise and lower this. Um, the the higher the reserve rate, the lower the multiplier is. So if we have to save 20%, 0.2, then it would only be a money multiplier of 1 divided by 0.2 is 5. And the lower the reserve rate, the bigger the money multiplier. So that's more, a quicker way to expand the money supply. And then there's what's called discount rates, which are the interest rate charged by the federal bank to other banks who are borrowing funds from it, because every bank doesn't have the exact same amount of deposits and desired borrowing. Banks can borrow money that they haven't had deposited from the Federal Reserve, and they loan that out at the discount rate. That's really the only interest rate that the Federal Reserve controls. So when we talk about them setting the interest rate, which is extremely low at this point, under 1%, that has implications for what the bank pays if you have money in savings on interest rates to you, or what they charge you if you're borrowing money to buy a home or buy a car or go to college. But the only interest rate really being covered by the Federal Reserve is this discount rate. And when the rates are lower, they encourage banks to borrow. And when the rates are higher, it discourages banks from borrowing. And so you either are expanding through encouraging bank borrowing or discouraging growth in the economy, expanding or contracting the economy as a result. Remember, when you get to a slide like this, to just pause the recording so you can look it over. What this is showing is a neoclassical view, because long range aggregate supply, the LRAS, is full kind of capacity of the economy. If we have an increase in demand, it can't increase the size of the economy because we're at full capacity. And so it can only impact price, which is what we experience as inflation, prices rising over time. The kind of map between the money supply, the interest rates, and how that stimulates investment and consumption and impacts the economy, which we talked about in earlier slides. This is just a way to visually show that. So you've got expansionary policy and contractionary policy here on the bottom. And then just seeing the impact, this is more of a Keynesian short-term view, supply and demand, seeing what happens in contractionary and expansionary policy. So again, pause, read through the details, and help yourself better understand the contents of each of those slides. So in recessionary periods, often banks will hold excess reserves created by expansionary monetary policy instead of making more loans. And this has a negative stimulative effect. So the goal of the Fed was to try and increase the size of the economy to get it going again by making interest rates low, and therefore encouraging people and businesses to borrow and banks to lend. But because of concern about the future, people respond, both the banks with a little bit more risk aversion, and so do borrowers in terms of companies and consumers. And so the intention to increase the monetary supply and to get the economy expanding is dampened or may not even take effect as a result of that fear and uncertainty. Velocity is how fast money moves in the system, and I will tell you that it's important not only how much currency is in an economic system. In our case, we're talking countries, but it's also very important how fast the money is moving as we spend it. It kind of circulates over and over again, and it has an expansionary effect to the overall economy. When we sit on money, we kind of pull it out of that system, and it slows the growth of the economy. So your exercise for this time is looking at velocity as well as money supply. Moving money, buy from the person to the right, sell the person for the left. So this is an exercise I would typically do in class. What we're going to do is for those of you who are online, I will open up one of the exercises for the chapter, and that chapter, their exercise is the one that you'll complete in place of this in-class experience. Thanks, and have a good day.